1. Who is Opendoor and what's their business model? Imagine Zillow, Redfin, and a house flipper had a baby. That's basically Opendoor. They're an iBuyer in residential real estate. They make cash offers on homes via an algorithm, then fix them up, then resell. Homeowners don't need to go through the traditional listing showings financing delays. If you just want speed and less hassle, Opendoor offers that. They also offer Opendoor Complete, where both buying and selling can be bundled to shave off friction and timeline. 2. Peers and competitive landscape. Opendoor doesn't operate in a vacuum. Their peers include Zillow and Redfin, though both have pulled back or exited aspects of the iBuyer space because of cost, inventory, and market risks. Traditional real estate agents, brokerages, they rely on slower, commission-based models. Other iBuyers, which are fewer now than before, the appeal was high during boom housing markets, but the margin pressures and inventory holding risks are big. Compared to peers, Opendoor's strengths are convenience, speed, breadth of markets, and the brand recognition. Its weaknesses: heavy capital expenditure, exposure to housing downturns, carrying costs, interest, maintenance, inventory risk, and historically, not yet profitable. 3. Recent price action and what's changed. Here's where things get interesting and wild. Since early July 2025, Opendoor's stock has exploded. It was trading under $1, around $50 cents 0.60, then zoomed up multiple 100% in just weeks. Leadership changes have helped feed enthusiasm. Co-founders Keith Rabois and Eric Wu are back on the board. Rabois became chairman. They also brought in Kaz Najatian, former Shopify COO, as the new CEO. Investors reacted strongly. The stock's meme stock status has really kicked in. Retail traders are vocal, online communities are buzzing, call option activity has spiked, and volume has been very strong. 4. Short squeeze theory, truth or hype? Does it make sense to believe a short squeeze is driving this? Let's break it down. Evidence for a short squeeze. Short interest is very high. Roughly 24% of Opendoor's free float is held by short sellers. That means many are betting the stock will go down. When the price rises, those short sellers may be forced to buy back shares, which pushes the price up further. The short squeeze score from services that track such risk is very high. Opendoor is flagged as a volatile battleground stock, high short interest, social media buzz, momentum trading. Evidence against a full short squeeze driving everything. Analysts remain very cautious. Despite the rally, many do not think the business fundamentals support these prices long term. Some have rated it underperform, with very low targets. Some of the shorting could be hedging and institutional positioning rather than bears who are going to get badly squeezed. The recent run seems heavily sentiment-driven, leadership changes, social media hype, retail FOMO, etc. that doesn't always sustain. When the music stops, volatility tends to spike downward. 5. Bottom line, what to watch. To quote The Empire Strikes Back, I find your lack of faith disturbing, but with Open, you gotta manage both hope and caution. Here are things I think you should track. Upcoming earnings. Any margin improvements? Reduced losses? Especially how they handle interest rates, inventory costs. Whether leadership can deliver on promises, e.g. turning the business model into something less capital intensive, improving operational efficiency. Short interest over time, and also how tight the borrow is. If short sellers can't get shares to borrow, that intensifies squeeze potential. Sentiment measures. Social media chatter, options volume, etc. They've been strong drivers. Compare housing market strength and mortgage rates. iBuyers are very sensitive to macro and housing supply, demand. 6. Conclusion. So, is Opendoor the next GameStop? Maybe in the story sense, the rally has similarities. But in the business sense, it's different. There are real risks. There is some possibility of short squeeze fuel, but it's far from guaranteed that short covering alone will sustain current price levels. If you believe in Opendoor, you're betting that leadership, cost control, housing markets, and consumer demand align just so. If any of those falters, this rocket could pull back hard. Thanks for watching Will of the Market. If you want updates, analysis, or want me to compare Opendoor versus a peer more closely, say Zillow versus Open, drop a comment, hit subscribe, and share this video. Until next time, may your trades have favorable odds, and may the market be ever in your favor.